Welcome to the current federal tax developments for the week of January the 6th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and your state society of CPAs. Well, welcome to the new decade. We're going to enter the 20s here with tax developments to see what's going on. And we'll take a look at some of the things that have happened here in the first week of the new decade, and some of which have happened toward the end of last year. As you probably remember, the last couple of weeks we've had special programs. 2 weeks ago, looking at the act that was passed by Congress, along with the Secure Act. The other things were in the final bill. And then last week we did kind of a review of the year. So we're going to start this week looking at some things that have happened since the last time we actually did a regular program. We do have a couple of California courses coming up now on the webcast for those of you who have access or maybe with a state that works with the California Society. On January the 14th, I just finished re-recording this one because unfortunately the course that was actually the live course that we taped from and did a live broadcast from was done just before the Secure Act got passed. So we had to go back and re-record. So we will have a brand new copy of Current Federal Tax Developments, the 8-hour course, this time updated for the end of year 2019 tax bills. That will be running on January the 14th. It will run both at 6 a.m. and 8 a.m. Pacific time. Obviously, adjust that as appropriate for where you are. If your state society participates with the CalCPA program, you should be able to register via your state society. Otherwise, you can register at calcpa.org. And find this particular course. It's on January the 14th. Like I said, we have two choices there for start times. That, as I've told people before, is always your clue that we're re-recording, that this is a rebroadcast rather than a live one. So don't expect your questions to be answered by audio version online, but we will be answering your questions during the day as you post questions during the session. So feel free to post your questions. Also feel free to sign up for that course. As I say, we will talk about the Secure Act. We will talk about the extenders. We will talk about some of the other stuff in the end of year bill, plus talk about the rest of stuff that happens during the year. I mention that because we're also offering around this at the same time 4-hour courses this month that deal just with the Secure Act. So if you just interested with an update for what happened with the Secure Act, I should say Secure Act and other the end of the year items, including the extenders, then you may want to look at those courses. We'll talk about those at the end of the session. Also coming up on the 15th, we're going to do advanced partnership issues featuring the new partnership audit regime and Tax Cuts and Jobs Act changes. That one is going to be of interest because we have that little problem that you may remember that we had the brand new audit regime for partnerships that a lot of people kind of forgot about because Tax Cuts and Jobs Act was happening. So we'll talk about that too. That again will be at 6 a.m. and 8 a.m. Pacific Standard Time for our start times. Well, remember what happened since we last met. I suppose I should mention this, though you want to check 2 weeks ago's podcast for the actual details. But since we last did the full broadcast, we had the H.R. 1865 Further Consolidated Appropriations Act of 2020. Remind you that, of course, that added a number of retirement plan provisions, major ones being the change in the treatment of inherited IRAs, also the issue that we had that went around with the change of the required beginning dates that will take effect. Just remember, it only takes effect if somebody hadn't obtained 70.5 by the end of 2019. We also talked about the extenders that made it and some that didn't. And we talked about the fact that 2 Tax Cuts and Jobs Act provisions were removed from the law by this. If you can't remember which ones they are, it is the unrelated business income treatment for the transportation benefit for employees of a not-for-profit, as well as the going back to the old kiddie tax rules. We had those go in, and we got rid of 3 Affordable Care Act taxes. The primary one that was gotten rid of, and of course none of these had ever actually been collected, was the Cadillac tax. Well, we also this week was interesting. I was listening to a discussion, Tony Nitty was doing a broadcast basically with Damian Martin on the Simply Tax podcast, and Tony was describing his top 10 tax cases of 2019 year-end review. And one of the ones he mentioned, though, he talked about a hobby loss case there, but he then mentioned a case that he said was really appropriate to look back for, that was very useful. And it kind of hit a chord with me because I had written this case up back when it first took place, but we've never had it on the update because it took place before we started doing these audio video updates. And so it's really the case of Story versus Commissioner. And it actually is, when you think about it, quite a good case in terms of how a taxpayer won on a hobby loss issue that's still relevant today. And also, to be honest, it's a case that took place here in Phoenix. So it actually was a case where, I happen to know the attorney who tried the case. And we had a full presentation, Phoenix Tax Workshop, not only from the attorney that tried the case, but from the attorney who was the taxpayer in the case, which was interesting. So how do you win a hobby loss case? And especially in this case, because it looks like the traditional loser hobby loss case in this sense. We have a high-earning professional. In this case, the high-earning professional was Ms. Story, who was the attorney, and she's a very successful attorney. Had a significant, as I recall, 7-figure income annually from her law practice. She specialized in water rights. So she did very well. She was doing very, very well. It was, in her practice. But she also decided to become a filmmaker. And she was doing a documentary on the group that you may remember if you're old enough, you may remember this group called Up With People. And she was making a documentary on that group because her husband had been, when he was a teenager, involved with Up With People. He participated in it for a while. So she did this documentary. The IRS, of course, said, well, wait, you've been losing money. You haven't gotten anything from this film yet. You're claiming all these deductions. We think this is a pure hobby loss. You're just doing it, because your husband was involved with Up With People, and so you're doing it as kind of a monument to your husband, basically to say, look at the wonderful things my husband has done, so sort of this, life story of husband. And you're also doing it because it's something you enjoy, it's fun, and you don't need it to make money because you make more than enough from your law practice to cover these losses from the film, so it just never has to make money. So clearly this is a hobby loss. I mean, it's, that is, in one sense, except for usually it's not making movies about your husband. It's normally when we're talking about horses, right? Horses are where we see this. But a lot of that story sounds familiar. Professional, doesn't need this thing to make money, seems to be going just fine. So how does all this work? How do we keep this running? Well, it's an interesting case. What happened here was because, Iris argues a hobby loss, but the court didn't necessarily buy that. Now, she had had 6 straight years of losses from the activity, and the years before the court were 2006, 7, and 8. And in fact, she never received any income until she got $250 screening fee in March 2010. And as you can kind of expect, $250, rather insignificant compared to her expenses. So, the IRS seems like, okay, we're set here. But the court said no. It's, the fact that she's lost money is not by itself indicative that this is a hobby that's disallowed under Section 183. Where the expenses be limited to the amount earned as income. And don't forget, those expenses be miscellaneous itemized deductions in the years in question, subject to 2% of AGI limitation. More importantly today, miscellaneous itemized deductions are not deductible whatsoever. So you have a total gross receipts tax on any hobby. If you make any money, the income is all taxable. There are no deductions allowed whatsoever. As Tony mentioned in the podcast with Damien, it's kind of like the marijuana, the cannabis issue, except you don't even get your cost of sales. So, yeah, it's kind of cannabis, but worse. So it's a problem. And the court said we have to look at the 9 factors in Regulation 1.183-2. Now, we all know infamously, I believe it was the 7th Circuit called these absurd tests, and we kind of understand that, but the court did look at this, and actually in this case I do think the test made sense as opposed to what the 7th Circuit may have dismissed in this case. In an earlier case, I should say, what we had. Well, the court rejected the tribute idea. The court said, look, obviously she could afford to do this and lose money. So, yeah, that's kind of one of the issues. You got to worry about that. But they said, look, she conducted this in a very businesslike manner. She formed an entity, maintained its own books, hired a bookkeeper that she consulted with. She prepared a business plan. She made changes to those plans to attempt to make this into something more profitable. She took steps to protect her reputation as a filmmaker, and she out there tried to market the film. Okay. Now, by the way, just not being successful, in the end is not proof you're a hobby. Sometimes you're just not good at sometimes the business just doesn't work, especially in filmmaking. Sometimes, you make a film and nobody seems to come to it. Just ask the people that produced the Cats movie that got released recently. It looks like people just didn't come. So, that's not necessarily a problem per se. The taxpayer retained experts in the industry with which he consulted to try to figure out how to do her film profitably, right? There is that option that asks, well, if the asset will rise in value, we can take on losses even though we can have current losses because we expect the rise in value to offset it. The court said in this case, that doesn't really count. I mean, that's sort of justification we have for, let's say, something like a rental. Rentals tend to lose money, but we expect the increase in value of the building to more than make up for the losses we've claimed in the prior years, so we still have our profit motive. It looks good there. Right? She did have some background, having produced musicals for a nonprofit, received commissions for bronze work, and she knew how to run a business. She was running her law practice. So that all seemed fine. They found that she was still in the startup phase. That explained why. Obviously, you're making this documentary. You have all these expenses incurred. You essentially can't actually show the film until it's complete. So the court said it was not unexpected that somebody doing what she's doing, a documentary filmmaker, should have losses initially and then would make money at the back end. They said, yes, the fact that she had sufficient income was to cover the losses. That is a factor that does lend toward believing it's a hobby. But they said if you compare all the other factors that the taxpayer in this case had going in her favor, then in reality, this one is not a hobby, at least not at this point. Now, the interesting thing you got to look at, a couple things. First, a number of documentary filmmakers and organizations filed amicus briefs with the court in support of Ms. Story. Because as we say, this is just the way that it works. You tend to, you're doing this, you're hoping you're going to make money off it. But, there are lots of reasons why a film ultimately does not make money. And, sometimes it just doesn't work. Like I said, nobody's going to go out there and argue that, that Cats, which I guess was a Universal picture, that Universal or Comcast was not attempting to make a profit. They were. The fact that they probably won't is not relevant. They were trying to make a profit. So it worked. That's the way it works. The other interesting thing, though, I think you have to pay attention to here, before you go bonkers and say, oh, great, hobby loss rules are not a problem for me anymore. Remember, this does have, like all cases, specific facts. This person, in many ways, had the best facts possible in terms of documentation. She did an excellent job documenting the case. I think there's a real good chance, had she been sloppy in her documentation, had she been a bit slipshod, had she not had the bookkeeper and the books, and had she not documented consultations with other filmmakers, had she not gone out and done marketing, basically, had she not gone out and worked on her reputation as a filmmaker to build that up, had she not documented all that work, I suspect this would have been your standard loser hobby loss case. In essence, facts matter. Facts matter a lot. And even though we hate to say it because, okay, most of you listening to this are accountants, right? Okay, we understand keeping records. We also know that we are dealing every day with people who have no concept of records, can't understand why records are involved, and think somehow at the end of the year, dropping off a bunch of pieces of paper and receipts, that we can magically create a whole year's worth of records and documentation out of their box. Yeah, those people probably aren't going to win this thing. they're going to lose a case like this. You've got to be realistic. But if you want to know what you have to do to make a hobby loss case work, Story is an excellent case. Again, it's from 2012, so it's been around a while, but all the facts in it and all the law in it is still relevant today, with the one caveat that the stakes are higher today because we cannot claim miscellaneous itemized deductions. Okay, let's come back to the current year. Now, we did have, and I mentioned this in passing a couple weeks ago when I said, yeah, we weren't covering, we weren't going to cover things in detail because we had just this IRS memo. But we're going to discuss the memo today, and this memo is going to impact those of you who maybe deal with the non-filers of the world, the late filers, all those sorts of people. And this is what the IRS is going to tell us, not surprisingly, I don't think, when they prepare a substitute for return. The substitute for return is generally prepared when the taxpayer simply hasn't filed a return. And the IRS will start taking what they have from information reporting sources, and they'll use that to prepare a return for the taxpayer. Okay, that's an SFR. Now, I've often told clients when you see things like CP 2000s for issues like where you forgot to include a sale of a security on the 1040, the IRS likes to use the sledgehammer approach. That is, you left off this sale of stock in AT&T, you got proceeds of $100,000. Obviously, your basis is zero, and it's a short-term capital loss. Or capital gain, I should say. Why? Because that usually produces a nice big amount of tax, and that motivates people to get their stuff together. So they actually respond to the notice, and they start working on it. So we've got those issues here, and that's what they're going to do. The question we ran into is, if the taxpayer has some of the information returns includes 1099 miscellaneouses with non-employee comp, or I guess in 2020 years, 2020 tax years and later, 1099 NECs, because remember, we're getting rid of 1099 miscellaneous for non-employee comp after we finish filing the 1099s for 2019. Should the IRS compute a deduction under Section 199, or 199 Cap A, I should say? And you'd think, well, look, here's this guy, he has $20,000 of income, right? It's all on 1099s from Uber. Let's say he did that. Well, shouldn't the IRS give this guy his $4,000, and we have no expense, and we know they're going to put any expenses on there, okay, fine. But shouldn't they give him the $4,000 deduction under Section 199 Cap A? And the answer is no. Why not, per this memo? It is still possible the taxpayer doesn't qualify. It is possible they have expenses which would reduce the 199 Cap A deduction. I know that's kind of weird logic, but it's also possible this thing does not rise to the level of trade or business. It's possible they have other income we don't know about, and suddenly we should be worrying about the fact they have no W-2 wages that we know of. We should be worrying about the fact this might be a specified service trade or business. Yeah, I know the 1099s from Uber, but theoretically Uber might have paid them, for, I don't know, accounting services. Probably not normal, but I'm sure they issue some 1099s to people other than drivers. So it's possible. And let's face it, the IRS is doing this to get you to file. So if the taxpayer wants to claim that deduction, which they probably will have a right to, they have to prepare their own delinquent return in response to the SFR, and then the IRS will consider, when that is given to them, the evidence involved to see if that will lead to a 199 Cap A deduction. So takeaway, if you want the 199 Cap A deduction, you got to file your own return. You can't just wait and let the IRS do an SFR. If you do the SFR and you don't take any action, which sometimes clients don't, then yeah, you won't have the 199 Cap A deduction. Now, this was interesting primarily by how late it came out. Notice 2020-05, next development, came out on December 31st, and the timestamp on the server on the IRS website indicated that they posted this about 9 a.m. in the morning Eastern on the last day of the year. They posted the auto mileage rates for 2020. Now, again, released on the last day. I don't know what took so long, but obviously it took them some time to do this. I don't know if there were fights over it. I don't know if there was concerns. I don't know if they were worried because they were dropping it, which they are. The business rate drops by 0.5 cents per mile. It will go from 58 to 57.5, right? we'll see the charitable will be 14 cents and medical is 17 cents. That 17% rate also applies in the rare cases where you can claim moving expenses. And again, that's mainly for those in the armed services. But if you have that, yeah, that'd be 17 cents for moving. Okay. It does give the rates to be used if you are using the standard mileage rate. The amount of depreciation you have for each mile, which has gone from 24 cents in 2016 to 27 cents in 2020. And again, you go back to each year and follow it. This has rates all the way back for the past 5 years, so you can get your depreciation reduction. The max auto value, if you have under an FAVR plan, the fixed and variable rate allowance plan, will be $50,400. And as well, that same number pops up as the maximum fair value of a vehicle provided to an employee if you're going to use the fleet valuation rule. I'm actually starting a new run right now because accidentally a mute button got hit when I recorded the first part. So we're adding a second segment here now. And we're going to continue on with this. So I had just finished this part of the auto mileage rate when this happened. So we're good. Let's go on then to take a look at the issues next that we're going to talk about, which are going to be what happens when we look at the IRS has revisited the virtual currency issues. And this is the issue of frequently asked questions regarding virtual currencies. Now, we visited this before back when the IRS first published in this area. And we started talking about what this means. But we didn't really spend much time on the charity aspect. They had a couple of little things about donations. We didn't spend any time on it. Now they've added some more sections for what a charity does if it receives a donation of virtual currency. And that opens up some issues we can discuss about what's different about giving virtual currency to a charity. So these were just added to the IRS's frequently asked questions page. And as I said, we already had our guidance for the donors. So what they had told donors was, this is question 33 in the current version of this. Now, as you may guess, as they add questions in the middle of things, they're changing question numbers. So if you're listening to this 6 months from now, don't be surprised if the question number is different. But it was question 33 as we record this. If I donate virtual currency to a charity, will I have to recognize income gain or loss? Answer, no. If you donate to them, it's a capital asset. And just like any capital asset, when you donate that, that's not a sale or exchange. That doesn't trigger gain or loss recognition. However, it does trigger a special rule because, again, what do you get to claim when you donate property? The default rule is you get to claim the lesser of the basis of the property or its fair market value. Now, you may say, wait a minute, no, you got that wrong. It's the higher of. No. Don't have that wrong. And there's a reason why I don't have that wrong. The reason why I don't have that wrong is A, it always is lesser of. But B, unless we have a special rule. If the property is personal property, and if it was sold, it would generate a long-term capital gain, then the taxpayer having to live with the 30% of AGI, not 60% of AGI limitation for cash-based items, or 50%, I guess now for this not quite cash based item because we have the special 60% rule now for cash. The taxpayer can claim the actual fair market value, in essence, without having to recognize the gain. But it has to be property that would generate capital gain if sold. It means long-term capital gain treatment. That means if you haven't held it for a long-term period yet, we have a problem. We cannot get that benefit. So that's the takeaway. But okay, that's fine. And of course, in question 34, that's exactly what they tell you. As long as you've held it over a year, you didn't just buy the Bitcoin 2 weeks ago and then donate it now, but you held the Bitcoin for more than a year, then you're going to treat it just like any other long-term capital gain asset, which will be, you will take essentially the fair market value. Because if the fair market value is less than the cost basis, then you always had to take that. If it's above the cost basis, as long as you're willing to live with a 30% limit, you can take that. You could elect to use cost if you want to get the 50% limitation. And again, it would be 50, not 60, because 60 is cash only. And yeah, I don't know. They've complicated that to no end. Let's just go on with that. But what about the charities reporting? This is what they added this time. And this is questions 35 and 36 were added. Question 35, they emphasize, look, This is not publicly traded stock. That's probably the thing to be realized. It is property. As such, what are your acknowledgement issues as a charity? Well, they remind them that to help your donors, if the value of the virtual currency is more than $250, the donor, if they're going to claim a deduction more than $250, needs to have a written acknowledgement contemporaneously from the charity. So you should acknowledge to the donor the contribution. That's the rule you normally live with. But number two, if the value of the virtual currency is more than $5,000, we have a problem. Why? That is not publicly traded stock. That means the donor is supposed to get this appraised, and you as a charity are supposed to sign the Form 8283 and acknowledge that you received that contribution. So they're reminding you that you need to do that. Now, they also remind the charity that you're not saying the valuation on the 8283 is right. That's not your responsibility. The donor and the IRS will work out how that works. Rather, you're just acknowledging you received the contribution. But that reminds us that the donor does need to get that appraisal. That's still going to be a problem. And they also talk in question 36 about the charity's own reporting. Again, this is not cash, so it's got to be considered donation of property for the Form 990 reporting. And they tell you that you report this as a non-cash contribution of Form 990 Series Annual Return and associated Schedule M if applicable. And they refer you to the instructions for both of those. But they also remind you, because this is property, you may have a filing requirement for Form 8282, Donatee's Information Return, if you sell, exchange, or dispose of the charitable deduction property, basically in it within 3 years after the date you receive it. And you got to give the donor a copy of that form and send it to the IRS. Reality is the charity is going to get rid of this stuff. So you're going to have the 8282 reporting issue for the charity, because they're not going to use this property as their charitable purpose. They're going to convert it to cash. Right? That's most likely what they're going to do. But even if they didn't convert to cash and they decide to pay with Bitcoin, that's still a sale or exchange. So they're still going to have the reporting requirement no matter what they do with this stuff. So again, the 8282, they're reminding charities of the need to file that form as well. Next up, we're going to take a look at a case we looked at earlier when it hit the tax court, the case of Messina versus Commissioner. This is case number 18-70186. It's from the Ninth Circuit Court of Appeals. It was issued on December 27th, 2019. Again, this had hit the tax court, and the issue in this case was this was two S corporations owned by the same two shareholders. One of the S corporations, the older S corporation, had been formed to buy a casino. Okay, that S corporation had not paid cash for the casino. They had put money down and signed a note to the old owners. Now, the casino was apparently hemorrhaging money and needed an inflow of cash. But the agreement that the S corporation had with the original owners was that if the new shareholders loaned money to the S corp, that debt had to be subordinated to the debt owed to the original owners. Well, the new owners weren't really keen about that subordination. Presumably, they're thinking that this whole thing might blow up and go south. We want to at least be at the front of the line to get paid, or at least get paid as much as the other people are getting paid. The old owners get proportionally that. So they went to their attorney and said, "Here's our agreement. Is there anything we can do so we're not going to be subordinated?" Their attorney advised them, "Well, if you do loan directly, it's going to be subordinated. But here's what you can do. It doesn't say a thing about a loan coming from a corporation controlled by you. So why don't you guys form another S corporation, put money into that S corporation, and have that S corporation loan the money to the casino. Then that note will not need to be subordinated, and then you'll be able to, not be at risk if this whole thing blows up. At least you'll be compensated proportionately for your debt with the old owners. So everything is great." Well, except of course, the problem is that if it's hemorrhaging money this badly, you think it probably has losses in excess of their basis? Yeah. So the taxpayers said, well, we understand the rule. The rule says that we can only claim basis for amounts loaned by us directly to the corporation. So here's what we're going to do. We are going to turn around and we are going to say, Ninth Circuit, really, that second corporation is really just kind of fake. At least that's what they said to the tax court. Tax court didn't buy this. Now we're at the Ninth Circuit. That's really a sham corporation. The substance of this transaction is we are loaning money to the casino. Now, first take on this is I suspect that's not what they're going to tell the old owners of the casino, that this is a sham, should be ignored. But let's skip that issue for a second. The Ninth Circuit said, we do not allow taxpayers to argue substance over form for transactions where they controlled the form. You guys chose this form, you live with this form. The IRS gets to argue that doctrine because they were never part of the negotiations and never were part of the decision-making process to choose this form. Since they didn't have any say in the deal, they can question the underlying economics. But you decided to use this form. Your choice, you're in full control. You could have done direct loans. Nothing stops you from doing direct loans. They may say, wait, but hold on for a second. I know about subordination. Hold on for just a second. But nothing stops you from loaning it directly, so tough luck. You did it. And we're not going to allow you to restructure this. But the court said, but even if we did allow substance over form in this argument, it wouldn't hold up here. There is a valid non-tax reason. That's non-business. There's a valid business reason that's a non-tax reason for structuring this as two corporations, and that is to avoid the subordination. So regardless, the form is valid here because the form is a true business reason for being. It is not a pure tax entity. It has a reason for being that is legitimate, is substantive, and it has to be respected. So Ninth Circuit said, you got to choose your poison. Either loan directly to the Casino S Corporation and subordinate, or avoid subordination by loaning through this other corporation, but you're not going to get basis for that loan because that loan is not from you. We agree with the tax court. Sorry, you can't make that argument. The real big takeaway from this is a reminder that, and the Ninth Circuit makes it very explicit for the Ninth Circuit, which is going to affect those of us here in Arizona, California, Oregon, Washington, Idaho, Hawaii, that, the Ninth Circuit absolutely can't do this. I got news for you. It really can't do it anywhere. Taxpayer is going to rarely be able to argue form or substance over form. And then we get back to the original section I got to say was 338, liquidations. That was actually a rare case where the courts allowed a taxpayer to argue substance over form. But it was a very unique set of situations. So I won't say it never works. I think the panel's overboard somewhat there. But I'm going to say it works so rarely that you might as well say it never works. And we'll just go from that standpoint. Hey, big things happen too that were not, big in one sense and not big in another. The IRS issued the final Qualified Opportunity Fund regulations, were issued in Treasury Decision 9889 and a set of frequently asked questions. They were issued on December 19, 2019. Now, what's interesting about this is these Treasury Decision, TD 9889, did not show up on the Federal Register site until the 31st. So 12 days later. Normally, these things show up on the Federal Register site first. That's where we find them. But in this case, the IRS posted it to their website first. And I don't know if they're just thinking that we're going to have a delay here, that something, the Federal Register is backed up, the people want to see these things, so we're going to get them out now with the caveat that, there may be some typo corrections by the time they hit the Federal Register. Have no idea what it is, but something of that sort. They are scheduled to be published on January the 13th. Now, normally they will be published when they hit this way. We have had exceptions. One exception in the past was for the partnership audit rules. That was because we got a new administration in town in the interim between the time they went to the Federal Register and the time they're supposed to be published. And an order was put down by the new administration to not issue, to put on hold all regs. That happens quite often. We change administrations, both federally and at state levels they do it. So this time we're not changing administrations right now. So bottom line, these should appear on January 13th in the site. There are some few interesting things in them. Now, the one caveat I'm going to say, in my practice, I have talked to a lot of people about opportunity zones. but I've only had one client who's actually gone ahead and done it. I mean, we're down to just nothing's happening. Why is it going that way? Well, the problem is almost every client, they start talking about it because they've heard about them, but they find something wrong. Like maybe they don't have any gains. That stops the show right there, right? You can't get the special 10-year rule unless you have gains. You have to reinvest gains to get it, and only gains. Maybe they just don't like that 10-year. They go, 10 years is a long time. I don't know, I want to hold it for 10 years. Maybe they weren't thrilled with the fact that if they die, their kids don't get a step-up in basis, right? In essence, it's going to be kind of lousy treatment on death. You know, they got to play along, get all the way to the 10-year period. And we know that the kids are going to probably want to liquidate everything. You know, they may not like the opportunity zone restrictions themselves. They may not like, there's all kinds of things. So in the end of the day, most people said no. They walked away from it. Nevertheless, and that's been true for most people in the classes I've talked to, and that's been true. Tony Nitty mentioned that in his nice article in Forbes that really does a great job of summarizing all these rules. And if you haven't looked at that online, search for it. Look for Opportunity Zone, Final Regulations, Tony Nitty. Get that Forbes article, read it. If you want to understand this stuff, that's where you want to go. He also recorded an hour-long podcast that was done on the Opportunity Zone podcast. Yes, there is such a thing. And you can get that. Search for that as well. You should find it. He has his full discussion. That goes on for about an hour. You want to go into the Opportunity Zone regs in detail, that's where to go. Here we're going to hit just the highlights. Big change in the final regs, 1231 gain treatment. In the original proposed regulations, or the second set, I should say, of proposed regs, we were told that if we had 1231 gains, we had to wait till December 31st of the year in question because we were waiting to see if they're going to be taxed as capital gains or not. Now we're saying, nope, skip that. 1231 gains, regardless of all your other 1231 gains and loss for the year, you can pick a 1231 gain and you can reinvest it within 180 days. So the 180 days starts when you trigger the gain. Why is that important? Because under the proposed regs, let's say I sold my rental for a $300,000 gain here in January. I would have to wait till the end of December to actually go put money in Opportunity Zone. And that's bad if I know about something I want to do right now. I had to wait all the way till the end of the year. Now we're saying, nope, don't have to worry about that. You can just reinvest. 180 days starts as soon as you trigger 1231 gain. The 1231 nature of the gain will hold on until the 2026 date when it'll pop back out. And then it'll be a 1231 gain again, and that year will be determined if it's going to be capital gain long term and how it's going to be taxed. But that all comes out at that point. Also, at that point, it'll be compared against whether we've had capital loss, where we've had 1231 losses in the prior 5 years that need to be recaptured. We also got some relief for partnership gains. Under the proposed regs, if a partnership had a gain, a qualified reinvestable gain, and the partnership didn't decide to reinvest on its own, the partner, by default, had his 180-day period begin in the last day of the tax year. So calendar year 2019, it wouldn't begin until December 31st, 2019. Okay, but that's when it would start. Unless the partnership told that person during the year, basically what day they had recognized the gain and how much would go to that partner. Then that partner could elect to treat the partnership's date that the partnership realized the gain as the start of its 180-day period to reinvest. So you could reinvest in something you knew about even though we weren't yet at year end. Well, that's great, except here's the problem. A lot of my clients invest in real estate partnerships that they're not going to have any information, or let's say real estate and other partnerships, they're not going to have any information about gains or losses until the K-1s come out in June or July. Well, since 180 days would start running at December 31st, if I don't get a K-1 until July, and I was never told about my share of gains before that date, I'm never going to have a chance to reinvest. So the IRS added a special rule that said you've got a second option. You can, instead of using the last day of the tax year, the partner can elect to use the due date, unextended due date of the partnership return, March 15th for the most part, as the start of the 180-day period. So third option, kind of nice for that. We were told that gains flowing to us from mutual funds, which is registered investment companies, or real estate investment trusts, those capital gains on that K-1, or not K-1, but on the 1099, yeah, the 180-day period starts with that on December 31st of the year in question. That makes sense. We're good there. We got some good news on installment gains, two things. Number one, if I recognize an installment gain, they should say get 12 monthly payments. I can treat each one of the gains, each month's recognition, each month's amount of gain I'd recognize as a separate reinvestment event, or I'm able to turn around and basically treat that, as one at the end of the year. Okay, good. But third, here's the big advantage. Let's say I've got a $500,000 installment gain. I'm going to collect my principal this year, recognize a $500,000 gain, but that relates to my sale of, let's say, a qualified asset that I could take installment basis on back in 2015. The IRS ruled, despite the fact that this sale took place in 2015, because the gains recognized after these rules came into place, in fact, during the period where we can do the reinvestment, we're able to take that $500,000 gain and defer it by investing in a qualified opportunity fund. That's good news. We also got an expansion of rules where a sale of an asset inside the qualified opportunity zone business that passes out to the owner, the equity holder, can be treated as an excludable gain for past the 10 years. That's also a nice change. Like I said, go listen to Tony's podcast or read Tony's article if you want to hear more go more deeply into opportunity zones. And again, if you're going there are a lot of traps. So you really want to take a look closely at this. Take a look at Tony's stuff, then go read the regs in detail, because there are a lot of ways to get yourself in trouble on these. So be careful, but we don't have time to go over all of that here today. Finally, we have here withholding on pensions issue. This is notice 2020-03 issued on December 18th. And previously, if you got a W-4P, that's for your withholding from your pension distributions. That was really very, very similar to a W-4. You claimed exemptions, right? Looked very similar. Nice, simple form. Take number of exemptions, and bingo, we're done. Well, you're probably aware the new W-4 is very, very different this year. A lot more involved, a lot more complex, a lot messier. Question becomes, what do these retirees do? And the IRS has decided that we're not going to change the way the retirees handle this. We're going to use the pre-2020 W-4 format for the pensions. So the exemption structure will be still in place for the formats using that. It'll all be tied in on the form. You'll be told how to do the withholding based on those forms, and we're just not going to really make a change there. Well, it is the end of CPE season coming up rapidly. Tax season's approaching. Be sure to get your pre-tax season CPE. We have 2 major state society webcasts that are coming up here shortly on the 2019 year-end law changes. Now, I already mentioned the current developments earlier in the podcast that we're going to be doing that covers the whole year. That will cover these as well, that 8-hour session. But here's the difference. The 8-hour session is not going to delve as deeply into these issues because it's got to cover everything else. This will be 4 hours purely of the new 2019 year-end items. So if you've already had your tax update, but you're like, oh man, I took my update and then they went and passed this dang act, and you just want to get up to speed on this act, that's kind of fill in. This is the one you want. If you want this act for whatever, you didn't do updates, but you want this act because it's brand new, this 4-hour one is probably the one you want. If you haven't had your updates, and you really should have your updates, then you want to take a look at the full-blown 8-hour update courses, either mine or there are others being offered still in the month of January. But the 4-hour course makes sense if this is your issue. And we'll be doing on January 8th at 8 a.m. Mountain Standard Time. We will be doing a 4-hour CPE. Well, 4-hour the way we work with CPE for accountants, which means actually, it'll start at 8 a.m. Mountain. It will end at 11:30 a.m. Mountain. We know. That's 4 hours, so just accept. It's the way we do it. So we'll have that there in Phoenix, and it'll be in the office in Phoenix if you want to come down live, as long as they have seats. You can sign up that way, but you want to sign up even if you're in Antarctica. You can sign up for the 4-hour webcast. So you can get ready, do that. I will also be then on the 14th of January. I'll be doing a session for the Idaho Society of CPAs. Same 4-hour sessions, same manual, same topics. We're going to be doing 4 hours there. So there's a second chance to pick this up live. Live one. And yes, this will be live, so we'll actually be answering questions that you may submit during the session. I'll try to keep my eye on those and answer those in the session, although we may have to defer some of them till later because I got news for you. I need to get through all the topics. So at a certain point, if we start getting overloaded with questions, we just start pushing the questions to like once I finish up with the session, then I'll stay around and answer questions and fill that out at the back end. So we'll see how questions go. Always iffy or something. How people are going to want, how fast the questions are going to start flooding in. So again, this is there. Arizona Society of CPAs, ASCPA.com, Idaho Society, IDCPA.org. You can sign up for either one of those right now, so you go check a look on those sites and find them. If you want to have the full 8-hour session, which will also be on the 14th, the 2 rebroadcasts that day, you can go ahead and pick those up on CalCPA's site or with your participating state society. So whatever works for you, we hopefully have you covered. This has been the Current Federal Tax Developments for the week of January the 6th, 2020. Well, you can basically follow our regular updates at currentfederaltaxdevelopments.com website. If you have any questions, you can email me, edzollers at currentfederaltaxdevelopments.com. You can also follow me on Twitter. That'll be at edzollers. And this week, I was honored and surprised to be listed on the 100 Twitter accounts to follow for taxes, published by Kelly Phillips Erb, an attorney who writes a regular column on Forbes' website. So you can go read about that there. You'll read some of the stuff she's writing. She also has put on her Twitter account, if you sign up and follow her, which you should also be able then to see her list she's put together, including the list of the 100 people to follow. And there's some very useful things to follow there. I know Twitter's a mess politically. I know for a lot of people use that as an echo chamber to just sign up with people who think like they do. And yeah, but if you stay away from that stuff and you just subscribe to these people, yes, some of them will drift into politics from time to time, so live with that. And good news is, I guess good news or bad depending on how you feel, they'll be on both sides of these things. So, we'll see things go, but they tend not to go off the deep end. They're not quite the wackos that fill up a lot of political Twitterverse. But in any event, we have this particular structure. You can do tax Twitter. That's how I get a lot of information for things where I know where something's happened. That's where I find a lot of it is being posted there. And there's some really, really useful resources there, so take a look there. I also follow discussions online on Reddit/r/TaxPros on the Reddit site. Again, that's reddit.com. You can also follow me. I also follow the discussions on California's Tax Talk listserv, which is open to any CPA anywhere in the country. So, and if you want to sign up for that, email me and I'll try to put you in touch with the parties that will get you onto that, because you have to be pre-approved to get in. But if you're, as long as you're licensed, you'll get in. We also follow the discussions on 3 state society connect groups that are members of the state societies. That includes the Arizona Society, the Minnesota Society, and New Jersey. If you want to post there, got information on those sites. Otherwise, we're back into the new decade. We're still waiting on the 163J regs, and unfortunately, because it looks like OIRA has scheduled meetings with people on the 8th, we're probably not going to see those regs for at least a couple more weeks at the earliest. So, and if you're waiting on that, it's probably not going to be next week's broadcast that talks about it. But we'll see what else. I'm sure other things will happen to keep us busy in the interim as the year gets going and we get ready to start a new tax season. So hopefully you're enjoying your final weeks of a little bit of free time until tax season starts. And in any event, we'll see you again here next week on Current Federal Tax Developments.